Okay, ladies and gentlemen, how are you? My name is John O'Donnell. I hope everybody can hear me fine. First of all, I'm the Chief Knowledge Officer of Online Trading Academy. My email address is john@tradingacademy.com. You might want to write that down. This is the end of the webinar. I'm going to offer you a special research series of webinars we have produced. I'm also the co-host of Power Trading Radio. You might want to write that website down, where we have over 500 hours of content, and that content streams off the FX Street website as well, powertradingradio.com. So let's get into this. The title of my talk today is the inflation-deflation debate. I'm going to give you an update on the inflation-deflation debate. I've done it on a few occasions, and I think it's one of the most important questions we all need to ask as traders and investors. What's happening to the fiat currency world today? I call this the globalization 3.0 new normal economies. And I call it the new normal economies because what we are experiencing is a, generally speaking, once-in-a-lifetime deleveraging of balance sheets. You see, credit is the mother's milk of capitalism. And there are two components of a credit instrument, a willing lender and a willing borrower. The price of credit is determined by supply and demand. The lenders create the supply, the borrowers create the demand. And when someone becomes insolvent or has financial problems and can't pay principal and interest on the agreed terms on a credit instrument, modern accounting laws require that you write off that credit instrument. And we have, in the fiat currency system world today, money that is backed with credit. And unfortunately, some of these credit instruments, especially in the private sector, in the developed world and the emerging world, are purging off balance sheets. And I want to talk about why that's happening and what the impact of that will be. And since currency of your country of origin is the denominator at which you measure value of goods and services that you either produce or consume on a regular basis, it's very, very important that we get our arms around, is the world headed for more inflation? That is, a symptom of which is a decline in the purchasing power of your specie currency, or is the world heading for deflation of credit-backed money, which means that the purchasing power of the currency actually appreciates in value. Now, in any dynamic economy, you have certain goods and services that are appreciating in cost, and then you have other currency units that are growing in purchasing power relative to a sector or a basket of goods and services, and it's usually dependent upon which sector is favorable toward credit conditions. There's a great book on this topic I'd like to recommend to you. You can get it at Amazon.com. The title of the book is What Has Government Done to Our Money? By Professor Murray Rothbard, who I met many years ago. I used to hang out with him at the Monetary Expo. I've been on the seminar circuit for the financial expo industry since 1973, and Murray Rothbard and Mises.org have been great mentors to me on this particular topic. I'm also a big fan of Winston Churchill, and one of my favorite Winston Churchill quotes that I think we traders need to keep in perspective, especially what's going on in the macroeconomic world of Western Europe and America and Japan today, is this quote by Churchill. A pessimist sees the difficulty in every opportunity. An optimist sees the opportunity in every difficulty. Ladies and gentlemen, the world has been and will continue to be very uncertain, and there will be lots of volatility. Our currency unit is supposed to be a medium of exchange and a store of value. But let me ask you a question. I'd like you to type in yes or no answer. Has the U.S. dollar, the reserve currency of the world, has it been since say 1900, a good medium of exchange? And has it been a good store of value? Why don't you type in your answer? Medium of exchange, store of value. Fiat currencies have a history through debasement and debauchement of the currency of actually burning wealth. And I want to take you through a little exercise here. Well, this is my chart since 1914 on the purchasing power of the U.S. dollar, and you can see the U.S. dollar has been it's been a good medium of exchange, certainly since World War II. But in purchasing power parity, it's been a terrible store of value, as evidenced by this chart. The purchasing power of the U.S. dollar going from roughly $1 in 1914 is now worth about 5 cents. So we have a real problem. This massive fluctuation and loss of purchasing power has created a lot of economic volatility. And these are some quick metrics on since June of 2009 of how the U.S. economy has evolved in GDP, total jobs, manufacturing jobs, home prices, disposable income, etc. And even though we have a lot of negative information here, look how corporate profits have escalated during this period of time. And the primary reason for that is corporations in America, at least, and I'm sure other parts of the world, this condition also has taken place. Corporations have become lean and mean. They started to delever their balance sheets and hoard cash. And they've kept the most productive employees and powered them with productivity tools. And in fact, they're getting more output per worker than they've ever received before. But at the end of the day, you can go back and look at the recording of this webinar, and you'll see the average recovery since 1945 of all these metrics is measured in yellow. And you'll see that by all historical standards since 1945, our economy is not doing very well at all. And I'm going to try to give you some insight into why that is today and my forecast for the future. Now, this chart gives me a lot of confidence. First of all, this is 100 years of price as measured in dollars of the U.S. stock market, which is the Dow Jones Industrial Average, which has historically been an excellent proxy for the ebb and flow of growth and contraction and innovation and adaptation of the American economy. In fact, it gives me a lot of hope. A lot of people think I'm a perma-bear. I'm not a perma-bear. It's just that we've been in a secular bear market since March of 2000, and I'm going to give you some data on that today that I think you're going to find remarkably transparent and document my case on why since first quarter of 2000 we have been in a secular bear market, and this rally we've had since March of 2009 is really only a cyclical rally within a longer-term secular bear. And I'm going to compare it to 3 other secular bear markets we've experienced and why we have some more to go in the expression of this bear market before we ultimately reach a bottom, which I believe will be in some time of 2016. But this chart gives me a lot of optimism, believe it or not. Now, what's interesting about this chart, since 1902 through 1971, we are measuring the stock market in a currency that is backed by gold. Nixon took America off the gold standard in 1971, and since 1971, in this chart, we've been looking at the Dow Jones Industrial Average in a fiat currency. But no matter if we're on a fiat currency or a gold-backed currency, using the dollar as my medium of exchange and its store of value characteristics, you can see that over time, no matter what negative event has been thrown at America, we have been very resilient, adaptive, and innovative to reinvent ourselves and survive and prosper to the next cycle. And I see no difference. This chart gives me great hope that America is one of the most resilient cultures in the world, and we will get through this mess that we're going through. As a matter of fact, we may get through it more easily than what Western Europe is going to get through their mess. And we could talk a little bit about that later if you would like. But this is another way to measure that same index. This is the Dow Gold Index. That is taking the nominal price of the Dow every Friday and dividing it by the nominal price of gold. And you can see, if I look at this chart and ask a very simple question, since if we were still on the gold standard, how many ounces of gold as money does it take to buy 1 unit of the Dow? And I could use anything as my denominator. I could use oil or soybeans or rice or wheat or corn or natural gas units. It doesn't really make a difference. I happen to use gold because for 3,000 years, gold has been real money. And if you want some more explanation of why that's important to a free society, I would encourage you to get Professor Rothbard's book, What Has Government Done to Our Money? But you can see very clearly, since first quarter of 2000, we have been in a secular bear market. In first quarter 2000, it took about 44 ounces of gold to buy 1 unit of the Dow, and today it takes about 7 ounces of gold to buy 1 unit of the Dow. You see, this was the real bull market in equities, okay? This is a real secular bear market in equities relative to the price of gold. Now, what's very interesting about that is how many ounces of gold does it take to buy the average U.S. home? Well, it used to take as many as 780 ounces of gold to buy 1 U.S. home in first quarter of 2000, and today it takes about 150 ounces of gold to buy the average U.S. home. So using gold as money, we start to get a totally different perspective of value, because unfortunately all you and I have been doing since we've had fiat currency is to measure the value and using British pounds or euros or dollars, which are all fiat-based currencies. It's basically like trying to measure the length of a foot, which is 12 inches in America. Well, what if you wanted to be in the business of measuring distance, but your measuring unit, that is the ruler of 12 inches, every day it shrunk a half inch? Well, if your unit of measurement is not constant, and I like to use constant metrics of measurement, and the one that society has favored for 3,000 years is gold. This asks a very interesting question. How many units of the Dow Jones Industrial Average does it take to buy the average U.S. home? And if you compare that to the previous chart, you start to build a very interesting picture of the future. What I'd like to show you is when I measure economic growth, I don't just use fiat currency. We presently have about a $14.5 trillion economy as measured in nominal fiat currency units. But in fact, if I again were to use gold as my constant metric of measurement and ask the question, how many ounces of gold did it take, or how many units of and billions of gold grams does it take to produce GDP, I get a chart that looks like this since 1930. And you can see we had real growth from 1930, using gold as my denominator again, until 1970. Then we had a significant decline in real growth, measured with this denominator, until 1980. We experienced real growth again into the first part of 2000, and of course, since 2000, we've had a decline in real GDP, measured in grams of gold, which in this case is my currency denominator. If I were to put up the GDP growth chart in either euros or pound sterling or dollars, or the dollar index, it would have a totally different picture. But ladies and gentlemen, in real terms, the economy today in the United States is back to the level it was, in grams of gold anyway, where it was in 1960. So this is an incredible picture of, is the global economy really growing? Now let's talk about the global economy. First of all, it's slowing. Global trade is slowing everywhere. And my metric to measure global trade is the Baltic Dry Index. And since 2005 through 2012, we've seen a very volatile priced Baltic Dry Index. I want you to note that the Baltic Dry Index, which is that measurement of the cost of freight to ship bulk commodities in one of those big container ships or across an ocean, you can see it's gone from roughly 12,000 to below 1,000. Well, this is a precipitous decline in freight rates. And why is this? It's not that they built more shipping capacity. It's because of demand destruction. The global economy is simply slowing. There's too much debt in the world. And what we have to do is purge the excess debt out of the world. So these are the three big pillars that are driving this new normal. We built too much capacity over the last 30 years in multiple sectors, financed with too much debt, and it's now led to the new normal credit purge economy, especially in the developed world, which is leading us to demand destruction. You know, the average widget factory in America, I don't know what the factory utilization rate is in Europe, but the average factory utilization rate in America is at about 76%. In good, robust economic growing times, it should be at about 90%. So we have a lot of capacity out there to produce goods and services. What we don't have is we don't have enough demand for widgets. That's our problem. People across the developed world are becoming more frugal in their lifestyle, and therefore they're not using credit to finance their conspicuous consumption lifestyle. And China is going to start to feel this very aggressively, I believe, in 2012 and into early 2013. I'm expecting the Chinese economy to slow precipitously from its present rate of growth. And ladies and gentlemen, let's take a look at this. These are the three big rocks that are driving this very recession resistant, or continuing, I should say, recession. We're really not creating any real jobs in America at all. And I know you've got a lot of problems in Europe. I had Jose Velasco on our Power Trading Radio show yesterday for an interview. He's from Spain, and he tells me that unemployment in Spain is over 24%, and among young people, unemployment's over 50%. That's just tragic. We're seeing that young college graduates in America today, coming out of college, some of the brightest and best that we have to offer, are having a very, very difficult time. And in many, many cases, they're seeing unemployment rates at over 50% as well. So, ladies and gentlemen, these are the three big rocks that are driving the economy, in my opinion. The implosion of global trade, the implosion of the household balance sheets in America and Europe, which is the condition where homeowners cannot borrow equity from their home to finance their conspicuous lifestyle, because we've had no real growth in wages in either Europe or America over the last decade. They've had to use the equity in their home, extract equity in their home to finance their lifestyle. And of course, the other problem we have is the implosion of the balance sheets of the banks. All this credit purge risk is primarily consolidated or aggregated on the balance sheet of our banking system. So what we're seeing is all over the world, in fact, we're seeing falling prices for goods and services. This happens to be the picture of what Great Britain looks like. Now, there was a great economist by the name of John Mills, and he asked a very important question, which I'll ask you. Do panics and crashes destroy capital? Well, he said, panics and crashes do not destroy capital. They merely reveal the extent to which it has been previously destroyed by its betrayal and hopelessly unproductive works. Ladies and gentlemen, my examples of what John Mills is talking about is the credit purge phenomenon that has impacted companies and countries like Greece, Lehman Brothers, GM, Chrysler, AIG, Fannie, Freddie, Merrill Lynch, Bear Stearns, Enron, WorldCom, Wachovia, the subprime housing crisis, Citibank, Bank of America, Countrywide, and Washington Mutual. We have seen precipitous declines in the credit instruments on these institutions' balance sheets. We have seen insolvency, and of course, it's impacted their equity price dramatically. And what we are experiencing, in fact, is credit deflation, not credit inflation. So let's get into the inflation deflation debate. Everybody believes that the central bankers of the world can simply create a bunch of fiat money and drop it out of a helicopter and paper over all the insolvent credit risks. It's really not feasible. It's just not feasible. At least that's the premise I want to go on for my side of the debate today. And it is a debate. There is an inflationist camp and there is a deflation camp. And depending upon what camp you stand in, basis your belief system, you should create a trading and investing plan entirely different if you believe in inflation than if you believe in deflation. Okay? So let's see what we can do to get into this. First of all, I want to recommend you go and study the Austrian School of Economics. I am not a Keynesian. The Austrian School of Economics predated Keynes. It came out of Vienna in the late 1800s. The primary flag carrier for the Austrian School of Economics is Ludwig von Mises and Friedrich Hayek. Go to mises.org, and there's a lot of free information about the Austrian School of Economics that we follow here at Online Trading Academy. We're not Keynesians. Now, the Austrian School of Economics has a totally different perspective of the root cause of inflation and deflation, and I'm going to try to articulate that for you. First of all, let's look at the simple principle of what is money. I mean, is this your accurate picture of money? This is your money stacked up at the back of your bank. This is your bank manager protecting your money. Is this an accurate picture? So my question would be to you, where is your money? When you put your money in the bank, where is it? Is this the accurate picture that we all have? Well, in fact, this is a very misleading picture of money. You see, the money supply, the value of money is determined by supply and demand. Okay? So let's take a look at this phenomenon. M1, M2, and gold are misleading measurements of money. In fact, the Austrian School of Economics teaches, and we'll define this a little more clearly in a moment, that money is the cash in our system and credit instruments outstanding in the public and private sector. Presently in America, we have $2 trillion of cash outstanding, but it's backed by the credit of $50 trillion of credit instruments outstanding. So if you look at the two components of the money supply, it would be cash plus credit equals the money supply. Now remember what's unique about the credit instrument. It is both an asset and a liability on a borrower and a lender's balance sheets. So here's a very interesting way to look at inflation, and I'm going to amend this a little bit for you today. In order to get into the debate, we've got to define our terms. According to Webster's dictionary, inflation is a process. It is not an event of a higher price. So inflation is an increase in the volume of money and credit relative to available goods. But I want to amend this just a little bit. And that amendment would be the credit instruments are marked to market. That's a very unique differentiator. So my definition would be inflation is an increase in the volume of money and credit but the credit is marked to market relative to available goods. Now, why do I use that? Because the credit component, our money, all of the fiat currencies are backed by credit instruments, many of which have dubious value and collectability. And I know what's going on in Europe, and if you don't believe that, ask Portugal, Spain, Greece, and ask the bond vigilantes who continually reprice their bids on both sovereign debt and private debt instruments that trade in the free market. So to understand the inflation-deflation debate we're going to have, you must understand the money and credit supply-demand equation. Now, this condition of massive dilution of the currency with massive acceleration in growth in debt as a percent of GDP is what led to the massive decline in purchasing power of the U.S. dollar from 1914 through 2012. I showed my last chart to our Heavenly Father, and he beamed back this image to me and told me that he wants to redesign the U.S. dollar's face value. I thought you'd get a little chuckle out of that. So, ladies and gentlemen, what is hyperinflation? Well, hyperinflation, as defined by the International Accounting Standards Boards, and there are some of you out there that believe we're going to have hyperinflation. I do not believe that at all, because the credit's getting purged at a faster rate right now in the private sector than what the governments can print fiat money. So the International Accounting Standards Board describes hyperinflation as a cumulative inflation rate over 3 years approaching 100%. That would be 26% per annum compounded for 3 years in a row. I do not see that in Europe. I do not see that in America, and we certainly haven't seen that in Japan. Okay? Now let's take a look at the credit creation mechanism. Remember, this is the total U.S. debt as a percent of GDP. This is both in the private sector and the public sector, and I want you to note that we've had a trend change. From 1870 through 1920, debt as a percent of GDP was about 150% of GDP. We had the credit binge of the 1920s, where we had available cheap liberal credit and society's appetite to use it. And credit binges under Austrian business theory always, without exception, ultimately lead to credit purge cycles. And this is the credit purge cycle of the 1930s. You see, what the Great Depression was, in fact, was 12,000 banks going out of business in America. Many banks went out of business in Europe because the banks became insolvent because people could not pay their existing debts on their balance sheet. That's what creates recessions and depressions. The credit instrument's purging, because once a credit instrument becomes impaired, accounting standards require the lender to take a hit to capital. After World War II, debt as a percent of GDP goes back to where it was in the 1870s. Look at this, for 3 decades. 3 decades. Debt as a percent of GDP was only about 150% of GDP, as low as 135% of GDP. And then Reagan's elected here in 1980, and what did Reagan bring to the party? Or what did he bring as a catalyst to bring this massive accelerating growth of debt as a percent of GDP to where it's over 300% of GDP today? He brought confidence. You see, the word credit, the Latin derivative for the word credit, means confidence. Confidence for what to happen? Confidence for lenders to lend, and confidence for borrowers to borrow and spend and consume. That's what drives economic growth. And ladies and gentlemen, what do we have right here? If this has been a 30-year trend, what do we have right here? What would you call this? Well, I'd call that a trend change. We are in the early stages of the credit being purged as a percent of GDP off the balance sheets of American financial institutions. And ladies and gentlemen, we can debate how intense this credit purge component is going to get. I happen to believe by the time it is finished, we're going to be down here in the vicinity of about 250% of GDP. I'm looking for at least a 50% retracement in this. And it's not that the euro is going to default or the U.S. dollar government treasuries are going to default, because there's $50 trillion of debt outstanding. Only $14 trillion of that is U.S. federal debt. That means $36 trillion of the $50 trillion in America is not attached to a printing press, and it's going to get purged out of the system to some degree. You know, John Maynard Keynes had a famous saying in a book he wrote called The Consequences of the Peace. And what he said was, by a continuing process of inflation, as we previously defined, government can confiscate secretly and unobserved an important part of the wealth of their citizens. John Maynard Keynes was an advocate of the inflation process. And ladies and gentlemen, I think that's a real challenge. I have a real challenge with that. What are we seeing now in America? We're seeing this humongous $12 trillion of consumer debt starting to delever. We're seeing many mortgages in America. 1 out of 4 mortgages in America today have negative equity. We're starting to see a rebirth of the foreclosure process after a 2-year moratorium. And unfortunately, the average American home is the largest asset on the balance sheet of the average American family and has been their primary source of credit over 30 years. And now all that is changing, as evidenced by this change of trend and credit being wiped out of the system. What other evidence do I have that consumer debt is purging off the balance sheet of the lenders and the borrowers? This is credit card debt, automobile debt, home equity revolving debt, mortgage debt, and the blue line, which is dramatically falling, is household debt as a percent of personal income. Ladies and gentlemen, if people don't want to borrow and spend, if people don't want to borrow money against their home, extract equity to go out and finance their conspicuous consumption and lifestyle, and if lenders don't want to lend unless you're premier credit risk, what's that going to involve? It's going to create a slowing of velocity of money in our economy. And that's exactly where we are today. And this is what it looks like. This is the trend of the debt ratio of the average U.S. household. Although it still remains high, it is starting to purge. It has turned the corner, and I see it reverting back. It's already down 11%. It's projected to go back, I believe, to the trend line that goes all the way back to 1955. And I see that this is where we are in the credit purge environment. Now, the government has been trying to prop this up. We've had trillions of dollars of quantitative easing and bailouts. And it sounds on the surface very inflationary. The problem is it's not working. It's just not working. And if you compare our government debt as a percent of GDP, you can see that the U.S. is up here in the same condition that Ireland is. Italy's in worse shape than we are. Greece is up here. You know what their problems are. And we've got Portugal and Spain down here below the United States. So you can go back and look at the recording and study these charts a little bit better. But let me tell you what I'm forecasting. What I think we're going to see, and of course, here is domestic, private, and public sector debt in Japan off the charts and the United Kingdom off the charts. If you see the United States, Germany, Australia, and Canada down here, on a relative basis, if you look at Japan, United Kingdom, Spain, France, Italy, and South Korea, they're in worse shape than we are. And so the whole world is going through this process of deleveraging. Let me give you my definition of inflation. Inflation is when you pay $15 for the $10 haircut you used to get for 2 real silver dollars when you had hair. Yes, ladies and gentlemen, we used to have silver currency in America. 4 quarters today, minted pre-1964, that are 900 fine silver, which have a $1 face value, are now bid in the marketplace at $25 in fiat money. Or excuse me, yes, $25 per $1 of silver face value. You see, ladies and gentlemen, the fiat money, and by the way, both of those currencies, one that's backed with silver and the one that is fiat-based, both of them are still legal tender and must comply with the legal tender laws of the United States. Let's talk about deflation. Here's how I look at deflation. The first order of business, in my mind, is in defining deflation in our lifestyle. An economic depression is a period of time in which the average standard of living declines significantly. I think all of us could relate to that. I believe that's what we're seeing now. Whatever the metrics produced by politicians and pundits may seem to tell us, our standard of living is declining. Now let's talk about the Webster's definition of inflation. And it is a process as well. It's not an event of a lower price. Prices are only a symptom of the inflation-deflation process. So deflation, then, is a contraction in the volume of money and credit, mark-to-market, relative to available goods. And as the credit component of the money supply shrinks, the dollars that are left over have more buying power. So falling prices, the symptom of inflation, are a consequence of this deflation process. The root cause of deflation, then, is debt destruction, bankruptcy, which is the conversion of creditor debt into equity. Thank you, General Motors. Banking contractions and other manifestations of deleveraging, and net change in social mood and appetite for risk. Remember, if consumers have become more frugal across the world, and their appetite for consumption is anemic relative to the salad days of mid-2000, when they could freely borrow money against their home to finance their conspicuous lifestyle, because real wages have been down for a decade, then the economies are going to slow. And the global slowing economy is about the demand destruction story. Now, the governments of the world, the central banks of the world, want to flood the system with cheap money, but nobody wants to borrow and spend it. The money's not getting to the street. It's not creating new jobs, new businesses at a fast enough pace. And this is what I see coming in the banking space. This is a very important chart, and it measures bank credit as a percent of GDP. Now, there are many channels of credit. There are many private and public channels of credit, other than a central bank fractional reserve banking system. This goes back to 1950. And notice the red line is the average, the mean. Now, you can see during the 50s, 60s, and through mid-70s, bank credit as a percent of GDP, which was an indication of the availability of credit and demand for credit, was about 136 to 145% of GDP. You can see how it folded in the recession of the mid-70s. Reagan's elected in 1980, and pinpoint that on your chart. And Reagan, what did Reagan bring to the party? Well, he created confidence to create a couple of different things. He was a catalyst to start confidence for 8 years, in 2 terms as president. And, of course, there are others that followed on. But it was Reagan that jump-started it. And what did Reagan do? He cut taxes, cut the effective tax rate dramatically, and he started deficit spending, encouraging people to borrow and spend. He brought back confidence. Confidence which drives demand for products and services. We've now driven debt as a percent of GDP, you can see at the top, to over 66% of GDP. This is not quite up to date. It's now down to about 63% of GDP, and that's the bend in the road. That is the trend change we talked about in the previous chart. And ladies and gentlemen, let me tell you what my forecast is. My forecast is, in this credit purge environment, that banks, corporations, individual families, everybody except government, but I mean municipalities and state governments, are going to contract their borrowing and spending. The only entity that's going to continue that pace is the federal government. Okay? But at the end of the day, I see credit coming back to where it was. I see the average at about 44% of GDP. I see it by 2015, 16 era coming back to 44% of GDP, the red line. Now, why do I say that? Because what do we know about markets? What we know about markets is markets are mean reversion animals. Embrace that. That's what markets do. We may not understand it, but if you take the time to study the history of price and valuation over time, markets mean revert. For a period of time, they go below average, and for a period of time, they go above average, but sooner or later, they come back and trade through the mean. That's the red line. I think that's where we're headed. As symptom that it's already started, and it started aggressively in 2009. Take a look at that blue chart, or that blue line on this particular chart. Now, how severe can the deleveraging pattern be? Well, I think we very well could look to the same pattern of deleveraging. This is the deleveraging pattern we've seen in the United Kingdom so far. In green is the deleveraging pattern we've seen in Spain. This in purple is the deleveraging pattern we've seen in the United States, down 11%. But look at Sweden. This is Sweden's deleveraging pattern, down 32%. And notice that the United States pattern of deleveraging is remarkably similar to the deleveraging pattern of Sweden. And my model tells me we're going to continue to follow that rate of deleveraging. I think that's a high probability trade. And we're already starting to see symptoms of it as well. Ladies and gentlemen, it's about 9:42. I've got about 3 minutes left, and I'd like to leave a little bit for questions. Let me see if there's any questions I can answer for you. Oh, one last chart I would like to show you. And this is what's happened in the deleveraging process in Japan. When Japan in 1989, in red, started their deleveraging process, it's had a big impact on their equity market. The Japanese equity market, as most of you probably know, has declined about 80%. The yen has skyrocketed in purchasing power. And by the way, what I expect to happen during this credit purge environment is the currencies, especially the U.S. dollar, to continue to be the flight to safety trade. And in fact, I expect the U.S. dollar index to exponentially rise against the euro, the British pound, the Japanese yen, and the Aussie. And the reason for that is we have more credit to purge out of the system faster than those other economies do. And that means the dollars that are left over are going to have more buying power. Now, I've laid over the top, by the way, not only did we see an escalating purchasing power, that is, at the top of this, it took 38,000 yen to buy 1 unit of the Nikkei index. Today it takes about 8,900 yen to buy 1 unit of the Nikkei index. We're going to see the same thing, we've seen the same thing in housing in Japan. From peak to trough, home prices in Japan, measured in yen, have declined over 65% and stayed down for 20 years. It takes time. Now, let me show you why that happened. The Keynesian approach in Japanese government when the recessions started and the deleveraging started to happen is that the federal government of Japan said, look, if the consumer is going to delever, which they did, private sector delevered from 273% down to about 100% today in blue, the government says, well, what we need to do is stimulate the economy, a classic Keynesian myth, and they start massive deficit spending, and they take Japanese government spending from 52% of GDP, and today it's over 200% of GDP. This chart's a little out of date. And my question to you is, class, did it work? Well, it did not work, as evidenced by this chart. Japanese stock market's down over 80%, and home prices are down. They've been in a recession for 20 years. They've had 7 periods of quantitative easing. and all it really creates is a little quick fix. The quick fix becomes unsustainable, and the bear market continues on and will continue to go on until all the bad credit instruments are purged out of the system. And only God knows how long that's going to take. In blue, I've laid over the top of this Japanese Nikkei index the S&P index. And you can see, ladies and gentlemen, our expression of greed and fear in the United States is remarkably similar to the greed and fear as expressed in Japan. So it's 9:45. I want to thank you for being part of this. My name is John O'Donnell. Email me, john@tradingacademy.com. Visit the tradingacademy.com website. Listen to Power Trading Radio. They will stream off of our website or off of FX Street's website. Thank you very much for your time and attention. God bless you all. Good luck.